Hello traders, I welcome you back to the Forex Geek channel where we break down the best trading strategies to help you level up your game. In this video, we are diving into one of the most important skills that every trader needs, okay? And that skill is called pattern recognition trading, okay? Or rather, it's called pattern recognition. So we are going to be looking at pattern recognition trading. If you've ever looked at a chart and wondered how professional traders predict market moves, it all comes down to recognizing patterns, right? So these patterns repeat over and over. And once you understand them, you can read the market with confidence. So before we get started, hit that like button to support the channel and subscribe if you want more expert trading insights every day. Now let us jump right in. Pattern recognition trading is all about spotting repeating structures in price action. Okay, markets move in cycles, yeah, and these cycles create patterns that traders can use to anticipate future movements. Whether you are trading forex, stocks, or crypto, understanding chart patterns can help you make better decisions and reduce uncertainty. Okay, patterns help traders identify potential entry and exit points. Patterns help traders understand market sentiment. Patterns also help traders avoid emotional trading and stick to a strategy. Now, let us just go over some of the most common chart patterns and how you can use them. All right. Let us talk about some of the most important patterns you should look for when trading. These patterns fall into two main categories. The first categories are reversal patterns. Okay, these signal that the trend is about to change, right? Like what we see happened around here. This was a reversal pattern because we are initially having a bullish trend. As you can see, obviously we were having a bullish trend, and then we had an M pattern form. We had an M pattern. It's a reversal pattern, a bearish reversal pattern. As you can see, an M pattern form, and it was respected. The pattern held, right? You can see that we had a breakout here. We had a breakout, and we even had a retest. Can you see? We had a retest and a continuation in the direction of the breakout. So this was a reversal pattern. Okay, this is just one of them. And then we also have continuation patterns. Continuation patterns suggest that the trend is likely to keep going. So whenever you are in a trend and you find a continuation pattern, we have a couple of continuation patterns. Let's just break down some of the most powerful patterns, right? Let's start with um this M pattern that I just talked about. It's called a double top. Okay, we have double tops and double bottoms. So this one is a double top. It forms when price reaches a high twice and fails to break higher. Then a double bottom is just the opposite. Okay, it signals a strong support level. Let's see, do we have a double bottom here? Well, I think it's kind of a double bottom, right? Because we can see that price got there twice. Is it twice or three times? Yeah, we can call this one and we can call this two. So we kind of had a double bottom here as well. You can see this is a W. So a double bottom pattern. You see this is like a W pattern, right? So this is also a reversal pattern. So this is double top, this is double bottom. Where this one is indicating a strong support level where buyers step in. Then another pattern we have is head and shoulders. Okay, let's just see if we can find an example, a good example of head and shoulders. Some of these patterns may not always come around. Okay, some of them are more difficult to find compared to others, right? Okay. um I think we might be able to use this as an example. I think we might be able to use this as an example because a head and shoulders pattern, usually the midpoint is the highest. The midpoint is the highest, and then you're gonna have, that's the reason why it's called head and shoulders. Then you're gonna have two, you know, two highs on both sides that are not as high as the head. So this is gonna be the shoulder, the first shoulder, right? And this is gonna be the second shoulder, and then this is what we call the neckline. Here is what we call the neckline. Okay, this is a classic reversal pattern that signals a potential trend change. It forms when price creates three peaks, 1, 2, 3, with the middle peak being the highest. Once the neckline is broken, the market usually shifts in the opposite direction, and you can see exactly what happened. Can you see? The neckline was broken. Can you see? It was broken, and there was even a retest. Look at that. There was a breakout, and there was a retest confirming the breakout was valid. And you can see the massive sell that we had after that, all the way down. So this was a reversal pattern that held, okay, the head and shoulders pattern. Then we also have triangles. There are ascending triangles, descending triangles, symmetrical triangles. These are continuation patterns, okay? We just talked about reversal patterns now, the head and shoulders and the double top and double bottom. These ones are reversal patterns. Then triangles are continuation patterns that indicate market consolidation before a breakout. Let's just see if we can find such example. Now, it doesn't mean that every time you find a triangle that there must be a continuation. In some cases, there could actually be a reversal, right? But let's just see if we can find a good example. Now, this is an example of a symmetrical triangle. Symmetrical triangle, as the name implies, it's kind of like symmetrical, right? You can see that the lines are converging. The trend lines are converging at a point, and then we usually have a breakout. So whenever there is a breakout, you'll notice that the price will likely continue in the direction of that breakout, like what happened here. So initially, this was a sell move, right? This was a sell move, and then we had this consolidation and we had a breakout. So in this case, it was a continuation. You can see it did not reverse, it continued, right, in this particular scenario. Then we also have ascending triangles. Okay, I'm just going to describe how it looks like, for the sake of time. Ascending triangles are, it's a scenario whereby you have prices consolidating. In this case, we have price consolidating, forming lower highs and higher lows, right? But in an ascending triangle, you're going to see something like the price is going to be forming higher lows. Yeah, price is going to be forming higher lows, but you will notice that the highs are usually around the same level. That's why it's called an ascending triangle. Okay, for the sake of time, to avoid taking a lot of time starting to search for an ascending triangle, you might not always find it, but in some cases you're going to find it. So that is an example of an ascending triangle. A descending triangle is just the opposite, right? Ascending triangle usually eventually leads to a breakout to the upside. Then a descending triangle is just it's a scenario whereby you have price consolidating but forming lower highs. Yeah, you're gonna see lower highs. That's why it's called the descending triangle. But the bottom level are usually around the same point, and it's most likely leads to a breakout to the downside. So these are the examples of triangles that we have. Okay, and these triangles, they could be continuation patterns. They could be a continuation pattern, or they could be a reversal pattern, depending on market condition. All right, depending on market condition. And then we also have flag and pennant patterns. Okay, flag patterns are they are a pattern whereby you have a surge in one direction, and then you have kind of a rectangular consolidation. Something like this. You can see we had a consolidation in a rectangular form, and then we had a breakout to the upside. So this is a continuation pattern. This is a bullish flag. It represents short-term continuation that forms after a strong price movement. So this is what we call a flag pole, and then this consolidation area is what we call the flag itself, right? This is the flag pole, and this is the flag, and then this is the breakout, and that led to a surge in the bullish direction. If it's a bearish flag is just going to be the opposite. A bearish flag, you're going to notice a sell move, and then you're going to notice a consolidation that forms a rectangular pattern, right? You're going to notice a consolidation, and then you will likely see a breakout to the downside. This is what we call a bearish flag. This is a bullish flag. Okay, then the difference between a flag and a pennant here is that a pennant is usually like a symmetrical triangle. So while the flag is like rectangle, the pennant is like a triangle. Let's see if we can find the pennant. But anyways, let me just describe how a pennant look like. This is a flag, right? But in a pennant, you're gonna see something like this. Yeah, you're gonna see something like this. Yeah, it's gonna be like a symmetrical triangle, just like how the flag is, rectangle. Pennant is gonna be like triangle. Okay, something like this, and then you might see a breakout to the downside. Okay, so that's just like the major difference between a flag and a pennant. Okay, in terms of the visibility, how it appears on the chart. So that is it for the major key trading patterns that you need to know. All right, these patterns are powerful tools, but they work best when combined with other indicators like volume, support and resistance, and trend lines. Okay, now that you know these key patterns, how do you apply them in real trading? Let's just look at a very simple approach. You have to scan the chart first, identify any familiar patterns forming on your chosen time frame. Then you can confirm with indicators, whether the RSI, MACD, moving averages, or any other indicator of your choice to confirm the pattern's strength. After that, ensure that you set your trading plan. Define your entry, your stop loss, target based on the pattern structure, and then wait for confirmation. Okay, never enter a trade too early. Wait for the price to break key levels before acting. Now, by consistently applying pattern recognition techniques, you'll gain a much better understanding of the market and improve your decision making. So there you have it. Pattern recognition trading is a game changer when it comes to reading the markets and making smart trading decisions. We covered why pattern recognition matters, the most common trading patterns, how to use these patterns in real trading. Now I want to hear from you. Which pattern do you use the most in your trading? Drop a comment below and let us talk about it. And before you go, don't forget to smash that like button if you found this video useful, and subscribe for more expert trading strategies every day. Thank you for watching, and I'll see you in the next one. Happy trading.